Hello and welcome to another video of real estate investing from novice to closing. My name is Jay Rios and today we're talking about step number 4 in this process, and that is your financial analyzer. This is really the spreadsheet that will make you your money and ultimately decide whether you invest or not invest. Whether this spreadsheet is used to garner other investors or to provide to a lender to show your knowledge of the investment or to pivot while you're in the middle of an investment, this is ultimately where you will probably be making most of your money. So in this video, we'll basically be going through a full process of analyzing a real life property that I have bought and exited, kind of how I found those numbers, what numbers you'll want to find, and then the metrics at the very end that I decided were worth actually putting my money into. There are really plenty of financial analyzers online that you can find, whether it's BiggerPockets or some other YouTuber. It doesn't really matter what analyzer you use. What matters is that you're comfortable with it, you understand it. Now I have to disclose this because the progeny of mine was actually from a gentleman named Chandler David Smith, who's an investor also here in the United States. He's got a YouTube channel himself. I've just kind of built on that as time has gone on. I highly recommend checking his channel out as well. As far as my own financial analyzer that has been honed and perfected over many years, more than happy to provide that. Just reach out to me directly or comment "analyze" down below. Regardless of what analyzer you use, the ultimate point is to do your due diligence to determine what the applicable expenses are up front and ongoing, the potential income that ultimately determines whether this investment is in fact worth pursuing. Once you've settled on an analyzer that you feel comfortable using, let's start actually focusing on subject properties. Remember that when looking to analyze something, there's really an abundance of information out there. No longer are there days when you needed an agent and access to the MLS to actually see what kind of real estate has been traded recently. Zillow, Trulia, Apartments.com, all sorts of rentals available and sales information via Zillow or any of the other websites that offer it. Zillow is the most popular and tends to have the most amount of filters to use, so that's typically where you're going to want to start. When I do due diligence, I like to start from as early as possible and start working my way toward present and then future. It's good to start at what has already been sold in the past. So in Zillow, there's a filter, click on it and you'll be able to see what has transacted over X amount of time. That way, it'll give you a good idea for what is currently listed and if that is accurate pricing or if it's just subject to the current market. When we look at these numbers, a lot of it will be very specific to your area. Each city charges differently for utilities or insurance, etc., and likewise, you can charge differently for your rent. Without further ado, let's get into the analyzer itself.
What you'll see here is that these rents are actually correlated with the next tab, year 1 profit and loss, which is then broken out on a monthly basis. So it's really helpful to be able to nitpick exactly how you expect each month to go. Ultimately, it is on more of a monthly basis as an investment. So rent 1, when we purchased it, I think they were paying $850 and $795 just for the sake of it. Say we bought it in May and then that continues on. So then from this we would say that $850 they paid 4 months, for example, and then they moved out, so then it was a 0 for September. Maybe you have some prorated rent, again just kind of generalizing here. Let's say there's a vacancy in September, they move in October 1, in which case at that point they're paying $1150, and then this individual stays, maybe they just end up renewing their lease for $975, and that way you can keep them there. That's typically the smartest way to do it. You don't ever really want 2 vacancies in a building because then it's just strictly out of pocket. But if you at least have one and you can kind of stagger the leases a little bit, you don't want them both ending at the same time. As far as maintenance and management and whatnot, as far as that goes, that's actually the inverse of the rent because this takes us back to the overall analysis. And as you can see in the income, this is now averaged over the 12 months. So this is what you should expect to make. All right, so maintenance is really number specific. A lot of people like to give it a percentage of gross potential rent, but I think it's more important to focus on how much you actually think you'll spend, the monetary exact amount. And that really has to do with talking with contractors and people who are doing the work so that you have a more accurate idea of how much it's going to cost. You're not just out there guessing. For this case, let's say it's 3%, and we'll call it 3% of 3% of this. There we go. Is that accurate? No. I mean, as you can see, it costs more than $6,000. So if you want to put 10% of what you totally be making, So you have to spend $2,200 on it. That's excluding the initial CapEx, because the capital expenditures should really be for asset improvements, not just, little things here and there. Management, if you're new, manage it yourself. Don't worry about going with a management company. Learn how to manage it so that you can see how it's done and know when it is being done correctly. Just for general sake, because a bank is going to want to see this, you can put 6% of again, the gross rent amount ultimately is what they look at. You can pay yourself out if you want to, and then report that on your tax return and whatnot. Utilities are going to vary depending on where you are, depending on, again, what you're charging, what you're being charged. So let's just call it $2,000, in this case, $1,000 each unit for water, sewer, trash, maybe some public electric if you have a hallway. There might be other expenses for the building that tenants themselves do not pay. Additional expenses, we can put in $500 over the course of a year. That's really not that much. It's $20 here and there for monthly. So it shouldn't really be much of a worry to put aside reserves. You really need to calculate that. Say you have a water heater that is on year 10 but only has a 15-year lifetime. You're going to know that over the next 5 years you need to save up to pay for that and not just pay for it out of pocket. Insurance, this is going to be one of the most fluctual numbers throughout the nation depending on where you are right now. Again, just for simplicity's sake, ours was $1,844, which was a great price at that point. PMI insurance, we're going to skip that for now. Typically, PMI insurance is paid when you pay less than 20%. As a down payment, it is just additional insurance that you do pay back the loan. You'll have to calculate that very specifically. Taxes should be easy to find for you or anybody else because it should be online. I mean, at least in St. Louis here, it's very easy to find by just going to St. Louis City or County Real Estate Assessor's website, and that is where they will have it listed right there, what is due and what was last year and the year before that. And so you can see kind of a progressive increase in taxes and calculate for the year after that and the year after that. And now down here, you're going to see some other numbers. Net operating income is ultimately the total income minus the total expenses that you have here. On a monthly basis, that's about $1,000. You think that's good, but we haven't calculated our mortgage yet. Now, our mortgage on a yearly basis is about $15,000, which is about $2,735 a month, which is negative cash flow by $228, okay? Everybody following so far? The debt service is calculated using some numbers that we actually skipped over at the beginning. These here, your interest, your years to pay off, your leverage, what the purchase price is minus the down payment is what the 184 is. These three numbers are then plugged into this amortization tab over here at the top here, and that'll get you what your monthly payment is. Amortization table is incredibly easy to find online. There's a ton of them to simply plug it in. That way you can see what your monthly payment will be, what your principal and interest will be, and how those will eventually inverse themselves the further down you get, right? As you go down to year 30, all of a sudden you're paying more principal than you are interest because that's just the way the loan works. So yes, over the course of the first year, money was lost. That is just how it goes sometimes. But if you look on a monthly basis, it's really just the beginning, and then it starts cash flowing here little by little as we get further into the investment. Now we can go into year two, and what I like to call kind of midterm investment. There's acquisition, there's mid, and then ultimately stabilization. But before we get into year two, let's look at some of these numbers that we have in the return analysis box. Okay, as we can see cash flow, it is not cash flowing. Therefore, our cash on cash return will be negative. That is not a horrible thing though. Again, you want to play out the investment throughout its full duration. The cap rate is pretty low. It's at a 5%. Return on investment is 4.3%. Only when you consider the principal down payment equity that you're gaining and then the tax exposure decrease from paying off maintenance and interest and all sorts of other things that your expenses can contribute to. And then return on equity is how much equity do you have in it, which at this point we don't really have any at all. All right, so moving on to your midterm investment analysis. Again, value of property, we can maybe put a little extra here after it's been 12 months. Say it's increased by $10,000, give or take. Now you've got a little equity in it. There you go. Additional capital expenditures. This is what you have to spend on the second year. Say you have a turnover in year two. Now you have to get back in there and repaint and everything, or you've got a sewer problem and you got to line it or whatnot, whatever you got to do to improve the asset itself. Again, not maintenance and repairs of just going in and doing little things here and there, but asset improvements that increase the value. It's very similar, in fact, the exact same to before rent one. In this case, it's just correlated to year two profit and loss. So you just kind of move your way along down these tabs. And now year two, we can say, at 1150, here we go. We put it in here, and then say they end up renewing for $1,200. There we go. All the way through. And then these folks were paying $975. And then if you extend it, they say they renew at $1,150. And there you go. And then once again, we want to put in our expenses here at the bottom. Let's see, 10% here. It's the same thing here. You want to put in your expenses in the bottom, down below here. So maintenance is 10% again. Management, say, is 6%. Utilities, I kind of like to creep them up every year because you know they go up. Inflation nowadays, $500 for the reserve, the insurance, is at $1,844. Let's say now it's at $1,950. The taxes also went up to $2,300, for example. So hooray, you're finally actually making money over the course of the second year now, on average at least. Now we can go back and see what these returns really look like. In this case, cash on cash return is still incredibly low. Cap rate is getting a little bit higher up there at 7%. And the return on investment is getting a little bit better too. Now to stabilization. Once again, we put in our numbers here and make sure they're all the same across the board. Additional capital expenditures, if you had any, you'd put them in there. Say you had a third turnover, or you had to replace the AC unit. Something like that would be entered in there. Cumulative capital expenditures is ultimately what you've been putting into the properties, which was $5,600, same as the first year. Cost to make rent ready was already included in that. Closing costs on home inspection were about 1.5%. Down payment, we'll call it 20%. Again, the credits, $1,600. Total capital required, was what we had initially. 30 years to pay off at a 7.2% interest rate. All right, just making sure those are all the same there. You're coming down to the stabilization and the rents for this section. So once again, we kind of take it back from here. If they're paying $1,200 there, we'll get them in there like that, and then they extend, and then say these people are now paying $1,250 when they renew, and now these people, you got them up to $1,200. Okay, so on average, you're making a pretty good amount, right? You're making about $2,400 monthly. So maintenance, again, we'll do the 10% deal here. Management, we'll do the 6%. Utilities, have them go up a little bit each month. Say it's now $2,100. Additional expenses of $500, insurance of $2,000, and taxes of $2,350. All right, so each month you are making a couple $100, which isn't great. The 5% cash on cash return is not fantastic, but let's take a look at some of the other numbers that could be possible. Say, for example, we ended up selling this, and your sales proceeds here. So the value of the property when we ended up actually listing it was $295,000, okay? We'll say 100% of the purchase, 80% would be for a refinance, but we'll call it that. Mortgage balance after year 3 is $180,000. The difference is about $114,000. Refi costs, or sales costs really, if you have to pay a commission here, say it's 4 or 5% basically. So the net refi proceeds is about $100,000, but you're not including what we've already had to pay into it, which is all of the down payment, closing costs, turnover costs. So let's get that in here. So after the net refi proceeds and the accumulated capital, such as the down payment and whatnot, have been calculated, that leaves you with a total profit of $46,000. That was from all the work that you've done after raising the rents, getting it to that value, and then ultimately selling it and profiting from the equity after the course of 3 years. It's not great cash flow at the beginning, but you still make the money at the very end if you can calculate for appreciation. That is not always encouraged either. Again, this is not investment advice, but I did understand that the area was going through some improvement.